The Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. We're watching Financial Planner, and Hemant Rustagi, CEO of Wiseinvest Advisors, joins in our Mumbai studios. Hemant, people like me who are small investors usually make the most common mistakes, which seem very common, which seem very simple to understand, but I guess we get them wrong a lot of times. There is so much of misconception. You sit out as an outsider. If you're a first-time investor, you just think the whole process of investing is extremely cumbersome. We might not be lazy, but it also seems to be a lot more difficult than it is. And therefore, we make a lot of mistakes. You might put off investing for the longest time, and you could actually start investing a lot earlier in life until it reaches a time that you've got to do it. How important is risk management when you talk about financial planning? And of course, where is it that investors like me go wrong, apart from just being, bogged down by the whole process of investing?
Well, you just mentioned about the process of financial planning. Before you even, start the process of, investing for your different goals, the topmost priority has to be given to the risk management. And when we talk about risk management, basically we're talking about life insurance cover, health insurance, insuring all your property that you have made over a period of time, and also ensuring that you have built an emergency reserve. Now, this has to be a top priority for any investor, and more so for a small investor, because there can be issues of liquidity at times for them. But unfortunately, most of the small investors either ignore this aspect completely, or they do it, randomly.
In a haphazard manner.
For example, if it's very common to see a small investor having insurance policies, and at times a number of policies, and they focus generally on investment come insurance products. Like you have these traditional options like endowment plan, you have whole life plan, and also sometimes looking at unit-linked insurance plan. Now, I have seen, portfolios where a small investor has 25, 30, 40 insurance policies. So what happens is, whatever policy is offered to them, they keep buying that without realizing. They actually don't look at that as insurance at all.
Investment.
They look at it as an investment. What they do not realize is that these are traditional insurance products. The returns that are offered by them is very, very low. Besides, the important thing that they ignore is that even if they look at total amount of risk cover which is being given by 25, 30 policies, we will nowhere near what they actually need. For example, we talk about a thumb rule for, a life insurance cover should be 10 times of your annual income. Now, there is no way these traditional insurance products are going to offer you that. So it's very important for a small investor to realize that they need, for risk cover, they should look at a term plan. The term plans are not only cheaper, but ensure that you get the kind of cover that you should be getting. Second is there's no point in having so many policies. Even if you want to include some traditional policies, be very selective. The second important thing is health insurance, as we talked about. Health insurance is very, very important. So if it's a small, young family, the best option can be a family floater health plan, which depending on the income or the requirement could be 8 lakhs, could be 9 lakhs, could be 10 lakhs, depending on how much is required. But health insurance has to be there. Third most important thing, which I said earlier also, is that if you own a house, make sure that is insured. And also if you have taken a loan, make sure that is also covered in your life insurance cover, because you don't want a situation there in case of an unfortunate event. For a small investor especially, the dependents will face a lot of hardship if something were to happen to him. And emergency fund is very, very important. The reason for that is, again, because once you start your investment process with a long-term objective, you make a commitment that every month you're going to invest X amount. Now, you don't want a situation where suddenly you require some money for some exigency, and you put a stop to all the process that you started with after planning so much. So these are the 4 factors which are integral part of the risk management, and I think every investor, especially a small investor, must focus on.
So in the list of priorities, insurance is what would be on top of the list, followed by contingency, and only then would you come down to investing?
Yes, absolutely, because once you have taken care of risk management, then you can be sure about one thing, that you will not disturb your long-term, short-term and medium-term investment process. And this will ensure that, like I said, if something were to happen to the earning member in the family, the dependent and the rest of the family members will not go through any financial hardship at least.
Hemant, retail investors usually prefer safe, traditional debt instruments. I guess we're so used to making those savings in FDs, and Indians are risk-averse generally. Despite equity markets in India doing so well and attracting all that foreign inflow of money, Indians themselves are not inclined to invest into equities unless they are pushed to do so. And forget about mutual funds, that's even further away from, being attracted to an investor. Why does that happen? And even if, yes, they want to invest into debt, they go after the traditional basic debt instruments which don't even beat inflation in terms of returns. So if you do want to invest in debt, what should a retail investor be looking to do? How should one go about doing it? I'm guessing there's more to it than just the traditional instruments available.
You're absolutely right. There is definitely much more to it. And I agree with you that, most of the small investor will have a substantial part of the portfolio invested in debt.
Or gold. That's the other one, yeah.
That's primarily because, there is a reason. There are two different risks that we always talk about. One is the risk of loss of capital. The second is inflation, a risk of inflation over the longer term. For most investors, they do not consider inflation risk as a risk at all. For them, the risk is that I should not lose a part of my capital. And that's why they have this fancy for all these traditional options.
And a lot of people are not even aware of what inflation is. The common man very rarely even knows what that is.
Exactly. Their focus is on nominal rate of return that they get. And they feel that, okay, if my money is growing at 7 or 8%,
I'm very happy.
I'm very happy. But like I said, there is definitely more to it. What every small investor needs to realize that when you're investing your money majorly into these traditional investment options like fixed deposits, you have these bonds, you have debentures. Okay, here we talked about these traditional insurance products. They offer very low return. Yes, of course, the major attraction, I know, the major attraction is that your money is safe, relatively safe. You feel that, if you're investing in these instruments, your money is safe. The second is that you are assured of a guaranteed return. These are the two major attractions for a retail investor. Barring exceptions like Provident Fund or PPF, most of these instruments are not tax efficient at all, which means that if you happen to be in a 20 or 30% tax bracket, a substantial part of your return will go into taxes. At the end of it, what you have post-tax return, you are going to struggle to beat inflation. So I think the time has come for investors to realize that inflation is a much bigger risk than loss of capital, especially when you're investing for the long run. So even if you don't want to make a shift completely from debt into equity, there are different options available in the debt category. For example, we have this market-linked products from mutual funds. Mutual fund offer a variety of debt funds. There are ultra short-term funds, there are short-term funds, income fund, gilt funds, and debt-oriented hybrid funds. There are a whole lot of variety of fund which is available from the mutual funds. So I think the time has come for investors to look beyond their comfort of investing in traditional options and consider investing in these. Of course, there are a few precautions that need to take. One is they need to select the right fund because there is an inverse relationship between interest rates and the bond prices. When you are investing in an income fund in a rising interest rate scenario, you may not get the kind of return that you're expecting. In that scenario, then you can look at fixed maturity plan. So there are a variety of funds which are available. It may not be possible for a retail investor to make a decision himself as to which fund is suitable. They can take help of a professional advisor if they like. I think it's a sensible thing to do rather than risking your money and, just because you're trying to earn a couple of percentage point higher return. But I think if they can take help from a professional advisor and invest the right way in the right proportion, I'm sure even on the debt portfolio, they can improve their return. And the important thing is that mutual funds are very tax efficient. For example, if you redeem your money after 1 year, okay, you pay only 10% capital gain tax, or if you claim indexation, you're paying only 20%. Now, let me explain that by an example. If the return is, let's say, 10%, and you kept it for, let's say, 1 year, after 1 year, the inflation is 7%, you have to pay tax only on the 3% at the rate of 20%, which means 0.6. So a post-tax return is going to be 9.6. Compare that with a traditional investment option, where you will end up paying 30% tax. The return is going to be only 7%. So as against 7, you get 9.6. Of course, there are attendant risk also, because in the traditional investment option, you are assured of getting that. Here, it can vary, but that's why I said it's very important to select the right fund, invest in the right proportion, and ensure that you monitor your portfolio. If you do, you can do these 2 or 3 things yourself or with the help of a professional. The results can be much, much better.
Hemant, talking about equities, most retail investors view equities as if it's an instrument to get rich overnight. None of that ever happens, and therefore a lot of people burn their fingers and get deterred from investing into equities. I know equities for the long term is known to be a wealth creator, and it's probably the best way to generate long-term wealth. But retail investors don't fall for that story because they can't be disciplined and they're not patient. So how exactly is that psyche expected to change? What needs to be done to change that psyche to begin with?
Well, I agree with you, Samir. I think it's a pity that there's such a low retail participation in asset class like equity, which has the potential to actually beat all other asset classes over the long term. But unfortunately, equity fund investor in India has a roller coaster ride. He has seen so many ups and downs. But the important point for them to understand is there is nothing wrong with their asset class. Okay, the problem happens when we do not invest the right way, we do not invest at the right time, we do not follow the right strategy, and we get carried away with the hype of stock market and maybe end up investing at the fag end of the rally. So the problem is basically how do we invest? So I strongly believe the time has come for investors to not look at equity with rose-colored glasses, but consider it as a very serious investment option, especially when your goal is to invest for the long term. So there are a few things that need to remember. One is that equity investment requires a time commitment, which means that, and as we discussed earlier, if you follow that asset allocation model, you make sure then in that case that only the long-term money goes into equity. Now this is very important because then it prepares you for all the ups and downs of the market. Imagine a situation where abruptly you decide to put money in equity and suddenly you see a downturn in the market, and because you've not come in with a clear time horizon in your mind, you're not prepared for the downside. So what you do then, suddenly you start shifting from equity into debt. So come with a clear time horizon, invest it as a part of your asset allocation, so which ensures that only the long-term money comes into that. Look at diversified investment vehicle. Do not try to invest yourself in the market if you do not have the wherewithal to do that, because equity investment requires you to have proper knowledge of what's happening in the economy, what's happening in the companies, what's happening in the global economies. So there are a lot of factors which decide how equity or a particular company is going to perform. So it's very, very important that look at a diversified investment vehicle like mutual fund. And as I mentioned earlier, equity requires a time commitment. If you come in with a 15-year horizon, stick to it, continue your investment process irrespective of the market conditions. The third important thing is do not try to time the market. Even the most experienced fund manager or the investors find it very, very difficult to do it consistently over a different period. So the thing is that if you follow a disciplined approach of investment, like you have systematic investment plan of mutual fund, you are investing at every level, so which means that over a period of time you benefit from averaging, which actually goes a long way in ensuring that you don't see so many ups and downs the way you would see it if you were to invest in a dog manner. So I think equity as an asset class a lot to offer. It's time for investors to realize that equity has to be an integral part of the portfolio. The key, of course, is that follow the right strategy, take the right product in your portfolio and invest in the right proportion. Do not get carried away with the market moves and invest a lot of money in that. I think if they follow these three factors or three things in their strategy, I don't see any reason why they will face disappointment in the past, in future, as they have done in the past. So I think it's time for them to really include equity in the portfolio, but like I said earlier, in the right proportion.
And how do you discourage daily tracking, because that also can wind you up, right?
Yeah, absolutely. There is no point. The point I'm trying to make is if I'm investing for 15 years,
why do I need to care what's happening on a daily basis?
Yes, look at once, twice at least in a year.
But that's all you need to do.
Make sure that the funds, it's very important, the point that you raise here. Investors need to realize that the commitment is to the asset class, not to the fund in which they've invested. When we talk about 15 years, they need to remain in the asset class, not necessarily in the same fund. So they must monitor it. But monitoring it on a daily basis is going to actually defeat the purpose. Look at least, maybe let's say twice in a year. Make sure that the funds that you're invested in are performing well in comparison to its benchmark and also its peer group. I believe that comparing with the peer group is much more important than only the benchmark, because if the benchmark has given a return of 10% annualized and the peer group has given 15%,
then your fund is
giving 12% or something, your fund has underperformed. So look at comparison with the peer group, keep an eye on how they're performing, but twice a year. Not every day.
How important is it to invest in gold? I mean, normally we buy gold for the sake of jewelry or as a hedge at best. But there's more to gold than that. And how much should one invest?
Well, I believe that gold, has the potential to be an integral part of any portfolio. And I think there are a couple of reasons for that. One, it's considered, as you rightly said, it's a hedge against inflation. Okay, it has a negative correlation with other asset classes. The major benefit of diversification is that there has to be negative correlation between the asset classes which are there in the portfolio. The third important factor why gold should be in the portfolio is there is no credit risk. Okay, so I think these are the three factors why the gold has to be in every portfolio. But the problem in our country is that most of the investors love buying physical gold, either in the form of a jewelry. My belief is that if someone is buying jewelry for personal consumption, by all means do that, but if it is for the purpose of investment, I don't think buying physical gold makes sense. There are other options that are available today. You have paper gold by way of gold ETF and gold saving fund. It's much more convenient to invest in them. You can buy 1 unit of gold every day if you like, and they are more tax efficient. For example, if you sell your gold fund after 1 year, it is treated as a long-term capital gain, as against the physical gold where you have to hold it for 3 years, and there is also a wealth tax there. So I think if you look at it in totality, this is much better. In terms of exposure, I would say, purely from investment purpose, it should not be more than 5 to 10% of your portfolio. But of course, when we talk about the long-term goal, one of the goals also is to, create gold reserve for, gifting it to your children at the time of marriage. If that is also considered here, maybe the proportion can vary a little bit. But broadly speaking, it should not be more than 5 to 10%.
Right, that's the advice coming in for all you retail investors on how you should be optimizing your returns from debt, equity and gold. We'll take a break on that note. We'll come back and take some of your financial planning queries, so stay tuned.
The Financial Planner, presented by BSC Investors Protection Planner, presented by BSC Investors Protection Fund.
Welcome back. You're watching Financial Planner.
Investment Ladder, presented by BSC Investors Protection Fund.
Hemant, we've got a query from Prashant saying, he says he's got 8 lakh rupees in cash, he wants to buy a car worth 10 lakhs, and he's also got an outstanding home loan of 23.5 lakhs. He pays 26,000 rupees of EMI on that home loan, so he can afford to pay about 50,000 as EMI for the home and the car together. He wants to complete both loans within 5 years. The rate of interest for the car loan is 9% and for the home loan it's 10%. Please suggest how much should he be paying as down payment for the car and as part payment of the home loan. What should the EMI be for both loans?
See, let me begin with the car loan. He's saying that he's planning to buy a car for, let's say, around 10 lakh rupees. He has to pay a margin money of 15 to 20%, which means he'll need around 1.5 to 2 lakh as a margin money. And currently, I think SBI is charging a rate of 10.75, but broadly, other banks are charging somewhere in the range of 11 to 12%. He said he's keen on, repaying the loan within 5 years. He can definitely opt for a car loan, which has to be paid over a period of 5 years. So as far as the car loan is concerned, I think things are pretty clear here. The second issue is that he wants to repay the housing loan. Well, repaying a loan prior to its committed period is always a good thing, but it may not be the good thing always in terms of housing loan. There are a few factors that an investor need to look at. What are these factors? One is that the tax benefits which are there on housing loan. The principal that you repay, you get a tax rebate under Section 80C. Right. Then up to 1.5 lakh of interest that you pay, you get a tax rebate on the interest part. Okay. And if the house is in the joint name of husband and wife, both can actually claim that exemption. So I believe that, when we talk about loan, there are good loans and the bad loans. I think housing loan is a good loan. And the reason for that is, one, it helps you in creating an asset. Plus, there are a lot of advantages. So I believe that before he decides to repay, and also needs to look at what is the remaining tenure of the loan. Look at these factors and then make a decision whether he needs to actually repay or not. Important point for him here is, there is always a temptation, like I said earlier, to repay the loan as early as possible. But then we have other goals in life. Housing is one of the goals that we have. Other goals could be for children education, their marriage, retirement planning. The important point for him to consider is, has he started the process of investing for those, or he just focusing only on one goal?
Which is a car and house.
If he hasn't, I think it's time for him to really list out his goals, assign a time horizon, follow the right process of financial planning, and start investing. He can always wait for some time to repay his housing loan. So my view is that if he hasn't started this process, he must begin that process, and then keep some part of it as an emergency reserve, as we always mention. So look at these factors before making a decision whether he should be repaying the housing loan now, or he should continue repaying it over a longer period.
Right, Prashant, that's the advice for you. We'll take a break on that. Now we'll come back and take some more queries, so stay tuned.
The Financial Planner, presented by BSC Investors Protection. The Financial Planner, presented by BSC Investors Protection Fund.
Welcome back. You're watching Financial Planner. Hemant, we've got another query coming in from Asit John, who writes in from Visakhapatnam. He says he started working about 11 months ago and he's an income of 30,000 rupees per month. He spends about 11,000 on loan repayment and 10,000 on miscellaneous expenses. he was wanting to invest the rest of it, which is about 9,000 rupees. He needs to accumulate 3 to 4 lakh rupees of cash after 3 years, and he also wants to invest in the long term. What should he do?
Well, he has not mentioned anything about whether he has insurance or not. So, as I always say, I think his first priority has to be to ensure that he has adequate risk cover by of life insurance and also health insurance. So if he hasn't done anything, I think that's where he needs to focus. Now, coming to his specific goal, he said he has a time horizon of around 3 years and he has a goal of 3 to 4 lakhs.
Yeah.
I assuming that, okay, if his target is 4 lakh rupees and time horizon of 3 years is not enough, especially when you're investing on a monthly basis, average holding period is only 1.5 years.
Yeah.
You can't really make your portfolio very aggressive. At best, you can look at some debt-oriented hybrid funds like Reliance MIP or HDFC MIP that we discussed earlier. He can consider investing in those, and assuming that he gets an annualized return of around, let's say, 10%, he will need to invest 9,000 rupees per month to achieve this goal of 4 lakhs. This is what exactly he has. He said he can invest 9,000 rupees. Now, as I mentioned earlier, if he hasn't started the process of risk management and if he decides to do it after listening to us, then he will have to change his goals a bit. He may not be having 9,000 rupees per month to invest because a part of that may go as the life insurance premium or health insurance premium. Assuming that he has already taken care of risk management and he still can invest 9,000 rupees, this is how he can start investing and achieve his goal of 4 lakh over the next 3 years. He's also mentioned that he wants to invest for the long term.
Yeah.
But as is very evident here, he will not have the money left for the long term.
Unless he, of course, lowers that 3 to 4 lakh rupees goal down.
Either he can do that, or the thing is that if his priority is the short-term goal, he may have something very important coming up after 3 years. In that case, my recommendation would be that as and when his income levels go up, okay, he should start the process of long-term investment, but try and start as early as possible, because for the long-term goals, it's important to start early because that is when you benefit from the power of compounding.
Also, very quickly, any sort of specific funds that he should be looking at?
Well, as I mentioned earlier, he can look at HDFC MIP and Reliance MIP. These are 2 funds that he can look at.
Investment Ladder, presented by BSC, Investors Protection Fund.
That's the advice coming in for you. Might find it a little difficult to accumulate about 3 to 4 lakh rupees over the next couple of years. But like Hemant said, risk management should be a top priority. You've just started working. You need to get that insurance in place if you don't already have that. And then use the surplus money to make those investments for your short-term goals and your long-term goals as well. With that, it's a wrap on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.